You want to avoid paying tens, maybe hundreds of thousands of dollars in capital gains taxes when selling your investment property? A 1031 exchange is one of the most powerful tools in real estate available to real estate investors. But if you don't follow the IRS strict rules, you could lose out on these tax benefits entirely. Today, I'm going to break down how to do a 1031 exchange the right way, and I'll be sharing 5 of the biggest mistakes investors make that can cost them tens of thousands of dollars. These mistakes I've seen people make time and time again, and trust me, you do not want to be one of them. So stick around, and by the end of this video, you'll have a very clear understanding of how to execute a 1031 exchange like a pro. Hi, I'm Chris Bain with Keller Williams Realty in San Diego. If you want expert insights on the San Diego market, whether you are buying, selling, downsizing, or looking to maximize your investment, with a 1031 exchange, be sure to subscribe and hit that notification bell. I post weekly videos and keep you informed on the latest real estate trends, and I'd love to help you navigate your next move. If you prefer, my contact information is in the description below, where you can call, text, email, or book a call directly into my calendar. A 1031 exchange is a powerful strategy that allows you to defer capital gains taxes when you sell an investment property and reinvest in another one of equal or greater value. Sounds simple enough, right? Well, the IRS has strict guidelines that you must follow, and one misstep can completely disqualify your exchange. That means you could be left with a hefty tax bill instead of keeping money working for you. In this video, I'll walk you through how a 1031 exchange works, and more importantly, I'll show you the 5 biggest mistakes that investors make and how you can avoid them. Before we dive into the mistakes, let's quickly go over how a 1031 exchange actually works. A 1031 exchange named after Section 1031 of the Internal Revenue Code allows you to defer paying capital gains taxes when you sell an investment property, as long as you reinvest the proceeds into another like-kind property. So what does that mean? The property you sell and the property you purchase must both be used for investment or business purposes. You must use a qualified intermediary, sometimes called a 1031 facilitator, to handle the transaction. You cannot receive the sale proceeds yourself, because if you do, the exchange becomes invalid and you're going to owe taxes. The value of the replacement property must be equal to or greater than the value of the property that you sold. All right, now that we have the basics down, let's go over the 5 biggest mistakes that could ruin your exchange. Mistake number 1, missing deadlines. This is by far one of the common mistakes, and it happens more often than you think. All right, the IRS has 2 very specific deadlines that you must follow. The first is the 45-day rule. Once you sell your property, you have 45 days to identify the replacement property, and you must submit this identification in writing to your qualified intermediary. The 180-day rule is you have 180 days from the sale of your original property to close on your replacement property. Now, these timelines run simultaneously, which means if you take 45 days to identify the property, you have 135 days left to close. Now, the biggest mistake investors make here is waiting until the last minute to start looking for a replacement. I always recommend identifying properties before you sell to avoid being rushed into a bad decision. You can also exchange into what's called a Delaware Statutory Trust, or a DST. This is where you're buying into a share of, let's say, a $100 million project. If you check out my podcast, Moving Mom and Downsizing Dad, we go over what a DST is, and we help figure out if it's right for you, because you have to qualify to get into a DST. Mistake number 2, choosing an ineligible property. Not all properties qualify for 1031 exchange, and this is where a lot of investors make very costly mistakes. Now, to qualify, the property must be called what's like-kind, but the IRS defines like-kind very broadly, so you can exchange an apartment building for a single-family rental, or even raw land for a commercial building. But here's the catch. You cannot use a 1031 exchange to buy a personal residence or a vacation home, but you can exchange mixed-use properties, but only the investment portion qualifies. So if you are unsure whether a property qualifies, you need to consult with a tax professional or a qualified intermediary before you move forward. By the way, if you are not working with me as your realtor, make sure your real estate agent has a qualified tax professional and an exchange accommodator you can talk to. Not having these conversations beforehand can get you into some big trouble. All right, mistake number 3, holding or controlling the sale proceeds. This is a deal killer. If you receive the proceeds from the sale of your investment property, even for a day, the IRS will consider it a taxable event. Now, to avoid these mistakes, you must use a qualified intermediary. This intermediary will hold the funds on your behalf and transfer them directly to the seller of your replacement property. Now, in my podcast, Moving Mom and Downsizing Dad, I sat down with Brandon Burns. He's a qualified 1031 intermediary, and he can help you answer all your questions that you have about 1031 exchanges, and he can go through the entire escrow process with you. You can check out my podcast with him right here. Now, if you try to deposit the money into your bank account, even temporarily, your exchange is over and you will owe taxes. Now, it must go from the escrow company to the exchange accommodator like Brandon immediately upon closing. Mistake number 4, underestimating the replacement property value. Another mistake investors make is buying a replacement property that is less expensive than the one they even sold. Now, here's why that's a problem. If the replacement property costs less than the one that you sold, the difference is called the boot, and that amount becomes taxable. So let me give you an example. If you sell a property for $1 million and buy a replacement property for $900,000, you're going to owe capital gains taxes on that $100,000 difference. Again, talk to a tax professional about this. Now, to fully defer your taxes, your replacement property must be of equal or greater value, and all exchange proceeds must be reinvested. Mistake number 5, not having a backup plan. Many investors assume that once they identify a replacement property, they're good to go. But deals fall through all the time, and if you don't have a backup, you could be left scrambling at the very last minute. The IRS allows you to identify up to 3 properties, so I always recommend using that rule to your advantage. This way, if the first choice doesn't work out, you have alternatives ready. This is where a DST comes in handy that we have talked about just a few minutes ago. By the way, a realtor cannot help you with the DST. Only financial planners with the Series 22 license can help you with a DST. So if your realtor tries to tell you they can, run as fast as you can. So be proactive and line up multiple options. That will help prevent your exchange from failing and save you a massive tax headache. If you found this video helpful, please give it a thumbs up and subscribe for more real estate insights. I post weekly videos on buying, selling, downsizing, and investment strategies like 1031 exchanges. If you are thinking about doing a 1031 exchange here in San Diego or anywhere in California, let's talk. I've helped investors successfully navigate the process, and I can help you too. My contact info is below in the description. Call, text, email, or book a consultation. Also, drop a comment below if you have any questions. I'm happy to answer. Thank you so much for watching, and I'll catch you on the next video.